Hello, everyone. Welcome to today's webinar. My name is Fawad Razaqzada, market analyst with Think Markets. I'm joined with my colleague Victor, who is in Sofia in Bulgaria. And together we present this webinar every week. It starts at 11:30 London time, and it lasts about half an hour. So if you're watching a recording of this on YouTube, please make sure to join us live, because when you join us live, you can ask us live questions, and we'd be more than happy to answer any questions that you have on any tradable market with Think Markets. And this webinar is meant to be quite interactive, so we'd appreciate for those of you who are here to ask us as many questions as possible. But just to give you an idea of how this webinar is done, if you're new to this, we cover the major currency pairs, stock indices, and commodities as well, mainly from a technical point of view, but we do also touch on fundamentals as well, especially Victor, who is more of a macro analyst than myself. I'm more of a technical analyst in these webinars anyway. But we'll get to the live charts in a minute or so. Please have a read through a risk warning, which is on the screen now. I'm just going to read the first paragraph with you. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. Okay, so we'll just go straight to the charts, and let me just get rid of this. We're gonna start off with the FX markets. You know, we don't update these charts too much, and we do it live. So some of the things that you'll see on this is kind of old now. I can get rid of this, for example. This is the daily, the weekly chart of the dollar index. And as you can see, the dollar index has bounced back in recent times. And it's now starting to climb back above the bearish trend line. It has it's starting to look a little bit bullish, and this is all due to the fact that the euro has underperformed, or mainly because of the euro's underperformance. Remember, the euro makes a big the euro dollar has a big say in the dollar index. The dollar index is basically an inverse chart of the euro dollar. So when the euro dollar falls, the dollar index typically goes up. On the daily, you can see the trend line more cleanly. This black line here was the last high at 91-ish. So from a bullish point of view, what you want to see is, can the dollar index hold above that level today? If it does, then the next likely target will be 91.75-ish, this low here. And after that, we have 92.13, which is this low right here. So those are the next key bullish targets, where we may also see some selling coming back into this former support area as well. But we shall see. Now, what the sellers would ideally like to see is for the breakout to fail here. So I talk about these concepts in the educational videos we've been producing on YouTube. And one of my favorite ways to engage with the markets is after seeing some false breaks, signs of a trap before getting into the market. So in this case, I am still of the view that the dollar has probably not done its downside, that this is possibly a mere short covering rebound, like we saw in here, for example, during September to October. So I think this is another kind of short covering bounce. I could be wrong, of course. And so what I want to see is for signs that the bulls will get trapped on the back of this breakout. So if the price, or the index in this case, goes back below the broken trend line, that would be a big bearish sign for me for the dollar. So watch out for that possibility. Now, I mentioned the euro dollar, so let's jump straight into the euro dollar. And we have been talking, myself and Victor, about what the euro dollar may do. And overall, it hasn't done too much since December or even November, after it broke above that 120 handle. It climbed, it staged a continuation of the rally, trying to climb towards that 125 handle where I thought it might go to. However, since the turn of the year, it has been printing lower lows and lower highs. And today it has broken below its most recent lows at 120.58, called at 120.60, this black line here.
Yeah, 2050, 2060 area.
Yeah.
As we mentioned, it was key for the bears or for the US dollar bulls to take that one out. And we've seen it happen today. Personally, I feel like there is a lot of momentum in this move, and it's going to carry through us at least towards 118. But you know, that's that's something that Fawad disagrees with me with.
You know what? You could be right. I don't know. I just think that with the I know the stock markets have come back down a little bit as well. But generally speaking, the stock markets
actually, speaking of that, we can observe a very swift change in the behavior of the dollar and as compared to the stock markets.
I was going to say,
because over recent weeks, while we have been making new highs across the stock market, the dollar has been rallying alongside with the stock market. We have seen that yesterday, reaffirmed yesterday, and it continues today. So basically, these flows, my theory is that these flows for dollar buying are related to US stocks, related to the appeal that high-tech companies have among investors worldwide, and their willingness to participate in this rally, giving up that this is their last opportunity to buy these stocks while they are quote unquote cheap. You know, we have observed an inverse correlation. If you go through, it's been absolutely inverse correlation between stocks and the dollar, and this has broken over recent weeks. This has been completely broken. One of these moves is going to end up reverting to the mean. So we're either going to see a decline in stocks or a rapid reversal in the dollar. I don't believe that we are anywhere close to this. I believe that this is just starting, and that the current melt up that we see in the stock market is driven purely by momentum.
I agree. If you think about it, we are in the middle of a lockdown, and the economy is not growing at the moment. Companies are not making profit. Well, some companies anyway are making, but the rest are not. It's really difficult to remain bullish on the stock markets at times like now. I mean, you know, we can talk about QE and, you know, other forms of stimulus by governments and so on. That has had the desired effect already. And stock markets have, in the US anyway, rallied to record highs. And I think with, you know, what we've seen in recent days with big technology companies reporting earnings, the results have been decent actually, but their share prices have struggled to push forward. Let's come back to the euro dollar in a minute. Let me just talk about this because we are talking about the stock markets now. If I show you a couple of examples, for example, look at Apple. This is the daily chart of Apple. It reported on the 27th of January, you know, a positive earnings that beat expectations, as you can see in here. However, look what happened to the stock. It fell. Yes, it's only a little bit of a correction. It's nothing major, but this is a theme across the board. If you look at, for example, I don't know, Netflix. Where are you, Netflix? You will see a similar picture. Netflix reported positive earnings, stock gapped, and since then it's kind of drifted lower. So not a great sign.
Well,
yeah.
This is I would say, I would argue that this is a standard behavior.
Yeah.
These stocks have been bought heavily into the earnings report.
Yeah.
So taking profits when the earning report is released is nothing out of the ordinary.
Yeah. Speaking of earnings, we have a couple of earnings today. So Google or Alphabet, they're going to report today after the close. This is the current stock market price action on the daily chart. We have Amazon, Alibaba, Pfizer, ExxonMobil, all reporting today. So that's going to take some of the focus away from the market talk that has been dominated by events unfolding in the internet forums, specifically in the Wall Street Bets Reddit community over the past several days, which saw shares of
or that is what the media wants you to think that
exactly
is
happening. So everyone's been talking about this stock GameStop, and look what happened yesterday. It plunged 30%, and it has continued to go lower in pre-market. So some of the frenzy has died down in the heavily shorted stocks such as GameStop, and even silver. If you look at the the price of silver, hold on, where's silver? Yeah, silver has indeed gone down from after peaking just above the previous high. The 2020 high was at 29.86. It hit 30 and it sold off from there. But as you can see by this blue line, I think it may start to form a base around this key support area. Anyway, we'll come back to this. So the point I'm making is some of the focus is going to go back onto the stock markets in the traditional stocks and the ones that caught everyone's attention during the pandemic, the stay-at-home e-commerce surge that we saw. So that's why I think Amazon is going to be really important, because obviously they're reporting off the close of business today, and the market, analysts are expecting the company to report another record sales and profit during the holiday quarter, and earnings from Amazon will provide us with strong clues about the health of the consumer, who have turned to online shopping amid the pandemic and with social distancing mandates, as well as physical retailers limiting operations. So Amazon had previously provided a guide for the fourth quarter that its revenue would grow between $112 to $121 billion. That would mark its first 100 billion plus quarter. Now, the average Wall Street earnings estimate suggests that Amazon will post a revenue in the upper end of that range, specifically around the 119 to 120 billion dollars, while its earnings per share would come in at $7.20, which would be up 11% year over year. So those are the key numbers to watch out for. 7.2 on the earnings per share basis, and 119 to 120 billion in terms of revenue or sales. If its actual results beat those expectations, then we may actually see Amazon go up, as you would expect it to do, and lift the wider stock markets with it. However, are we going to see a similar reaction to how other stocks have performed, other tech stocks like Apple, as I showed you, initially gapping higher on the back of earnings and then going down? We shall see. But the stock indices have bounced off their lows in recent, since yesterday. If you look at the S&P 500, it formed a nice looking, what do you call that? Bullish engulfing kind of, yeah, reversal off the trend line. There's a trend line here. And if you look at the Ftse 100, this was previously a key support area. It broke below it, but yesterday it formed this similar
double bottom,
whatever you call that. Yeah, it needs to get back above this shaded region, I think, for me to turn bullish on this again, because of recent price action, specifically the bearish trend line. So it needs to get above there, and I would turn bullish on the Ftse once again. But let's see if this candle that we saw yesterday marks a turning point. Similar price action on the German DAX index. Big bullish engulfing candle yesterday, and we've seen some follow through. But it needs to get above this bull flag. If it's still a bull flag, we can adjust this a little bit. What do you call this pattern?
Well, I'm not really on your
megaphone.
Something like that.
The point I'm trying to make is it's in consolidation, right? So it needs to make a higher high here. So the most recent high comes in at. Sorry, we've kind of gone in and talked about other markets. I will come back to the FX markets. The most recent high is this high here at call that for 13,925-ish. So if you go above that, then it is bullish again, in my view. Where were we and why did we end up here? Let's go back to the Forex markets. And yeah, we were talking about the euro dollar, weren't we? And specifically about what the euro might do around this area. So it's coming down to test this bullish trend line. And the reason I wanted to talk about the stock markets is because previously the euro dollar was rising along with the stock markets. So in other words, the dollar, as Victor mentioned, the dollar was selling off when the stock markets were going up. We have seen the reverse of that in the last several weeks, where the dollar is going up and stocks have come down a little bit, although yesterday they bounced. So it's kind of a mixed picture on that front. But with the stock markets still, making longer term higher highs and higher lows, can the euro dollar stage a recovery? For me, the key support area is 120. This was the previous breakout area. This level has been untested since price broke above it. So we have the bullish trend line coming into play here as well. With so many technical factors converging here, what I would like to see from a bullish point of view is for the market to test this level and then bounce and then go back above this black line at 120, 60-ish, which was the previous support. That would create a hammer-like look candle on the daily time frame if that happens, potentially providing as a bullish signal to signal that the market is going to go higher. In contrast, if we get a clean break down below 120 and the trend line, which is what Victor is presumably expecting, then in that case,
I've been expecting it since 123, man. Remember that?
yes. You called the top some weeks ago. So if Victor continues to be right and the euro dollar breaks 120, then rounded retest of previous support levels, such as if you go below 120, then a rounded retest of that level could provide us with a possible shorting opportunity to take us down to the next round handle at 119, possibly all the way down to 118, and maybe more over time. But yeah, what happens today is going to be really important for the euro dollar in terms of, as far as technical analysis is concerned anyway. So keep an eye on the euro dollar at this level. Similarly, we've seen the pound weaken a little bit, although it has still managed to kind of hold above the.
It just continues to thread water.
Exactly. So previously, I was expecting it to do something like that because we avoided a no deal Brexit, etc., to go up all the way to 140. The fact that it's not, the fact that it's struggling to make headway is making me a bit nervous in that outlook. So
Yeah.
I don't have to.
At this point in time, like the break below 130, a clean break below 136.50, if you ask me, is enough for it to correct towards 133, something like that.
Yeah.
And with broad dollar strength, that's not out of the question.
Absolutely.
Mind you, there is another currency that I really want to talk about, which is the Aussie.
The Aussie. Okay, let me just load up the chart. Is that the Aussie dollar?
Yeah.
Okay. Oh.
The Aussie dollar has been also signaling this broad dollar strength.
Yeah.
That typically when the stock market is rising, the Australian dollar is rising along with it, and there is no headwinds. And we are close to the all-time high in stock market, and there is no sign of the Australian dollar picking up from that strength and reversing its recent downtrend against the US dollar. So this to me signals how stretched the positioning in the US dollar has become.
Yeah.
People have basically started assuming that the dollar the dollar is a one-way trade.
Yeah.
And it will keep on falling and falling. But I really disagree with this from a fundamental perspective, because to me the fiscal impetus and the monetary impetus in the US are very, very, very constructive. And if we compare this situation to what happened last year, when everyone was starting to get very, very bullish on the dollar in March, when it broke through some key levels. I think we're on the opposite side now, and it just makes sense to revert to the mean, which in the case of the euro of the Aussie is the 200-day moving average around 72. I guess that sounds like a more fair value to me.
Yeah, I mean, obviously the FX markets, there are kind of the way that the price action happens or unfolds in the FX markets is, I have learned anyway throughout my years in the markets, it is a lot different to the stock markets. The stock markets, they typically undershoot or overshoot to downside or upside based on some fundamental stimulus, where the currency markets, they don't typically rise or fall as much as the stock markets do to some fundamental stimulus. And I think with the current situation, rising stock markets and falling dollar, that trend has to change eventually. And you could be right, this could be the time that could happen. But obviously, as short-term technical analysts or traders, we need to see that trigger. And for me, the trigger in the case of the Aussie or in the case of the euro would be a breakdown below that bullish trend line. So let's see if we get a clean breakdown below this, and if we can hold below it. That would be the trigger for me for a short-term drop in the Aussie dollar. Because so far, yes, it has come off the highs. It's only come down, 200 pips, if that. So it hasn't been a significant drop yet, which is, we've seen similar retracements in the past. If I can highlight a few examples, for example, here, and so on. And this could be another example of that. So yes, it's a warning sign definitely, but we need to see that trigger before turning bearish on the Aussie or bullish on the US dollar as a currency. I wanted to highlight, talk about the euro pound again, because we keep mentioning this in our webinars, and this is continuing to show strength for the pound. The euro pound recently broke below the trend line of a head and shoulders pattern, and it's making lower lows and lower highs. And with the euro pound going down, if you are bullish on the US dollar, then shorting the euro dollar makes more sense based on the price action on the euro pound. However, if you're bullish on the dollar, if you're bearish on the dollar, then looking for long setups would make sense in the pound against the dollar rather than the euro against the dollar, because the euro is a weaker currency out of the two. So if you're bearish on the dollar, look for long setups in the pound against the dollar. If you are bullish on the dollar, then look for bearish setups in the euro against the dollar. Does that make sense?
Oh, yes.
Yeah. So if you want to take out the dollar out of the equation, then this is one of the best currency pairs, in my view, that's trending at the moment to trade. And other pound crosses as well, they kind of look promising. One particular currency pound cross is the pound Swiss. I have been talking about in recent times. And if you allow me to look at the longer term chart first, this is the weekly chart. Price had been in this had been contained by this resistance level at 122 since March 2020. This week, however, it has peaked above that level. So the path of least resistance for this pound cross, the pound against the Swiss, is to the upside. And from here, it could easily go to 125 or slightly higher than that, which was the base of the previous breakdown. So the pound is showing strength across the board. And indeed, if you look at the pound against the yen, this is not the hourly chart. This is the weekly chart. We have broken above the previous high as we had anticipated previously. It has also broken above the long-term bearish trend. So
that's
if you look at
the most constructive pound pair.
Exactly. So if you look at the yen crosses, the yen is weakening. It's not really telling us we are heading into risk off, because typically when the stock markets fall or we are or investors are getting nervous about something, we typically see flows into the Japanese yen, but it's not happening. And even the dollar yen is rising. So you have to be careful how you interpret that price action on the Aussie dollar, because if you think that the markets may top out based on the recent drop in the Aussie dollar, while it could happen, it's not a given, because the FX markets are not all signaling the same signal, which is risk off. It's it's providing you a mixed signal. So yen is falling as a currency, and commodity dollars like the Aussie, Kiwi, and Canadian dollar, they've all fallen as well, which is not what you typically tend to see, but it does happen from time to time. So we want to talk about gold and silver because obviously of what happened in silver and gold. And I think, Victor, you said you had a few things to talk about these metals, right? So do you want to talk about gold or silver first?
Well, let's talk about silver, because it's the topic for mainstream media these days, and another projection of an illusion that retail traders are moving the market, cornering the silver market to push it higher. I really don't. I can't see that happening.
Who was the previous attempt? It was the Hunt brothers, right? In the 1970s, when they tried to corner the silver market. Do you know about that story? Yeah.
Yes.
Yeah. They were almost successful at doing that. but even they failed, even though they had like billions of dollars to play with. And in 1970s, when the market was a lot smaller than what it is today, but they failed with the silver market. So good luck, retail investors.
Good luck to everyone who tries to bet against big money.
Yeah.
But anyways, some people were saying that this move in silver has been driven by a couple of posts on Reddit that have decided apparently to. So some people on Reddit coordinating and deciding that they want to push up the paper market for silver in order to demonstrate that there is not enough metal in the vaults of the CME to cover their obligations if at expiry.
Yeah.
Um,
which is a fair point, isn't it? The paper market is huge compared to how much physical silver is in the vaults of the CME and other institutions.
And compared to how much metal is needed.
Yeah.
Since most of these transactions are settled on paper anyway.
Yeah.
So the attempt to break through the previous high around $30 has faltered yesterday.
Yeah.
And ever since the US market opened yesterday, we have seen a relentless move downward, coupled with the media who was screaming, "Oh no, this is the breakdown in the silver. The breakup in the silver, and this is it. Like the Redditors are going to do it again, but this time to silver." And of course not. So I wouldn't touch silver with a 10-foot pole for now. To be frank, while this is going on, I wouldn't be buying at these levels. If you look at our weekly or monthly charts, these levels are
from quite, longer term. This is a monthly.
Quite stretched. We have had a rally from $12 to $30, which is well over 100% move.
Yeah.
So I really want to see some consolidation before getting into this market. On the long side, if you're a brave one, you can play it on the short side, because that could still play out rather well from these levels, because none of the pullbacks, none of the pullbacks that we have seen since the gap higher yesterday has materialized in some bounce of any support level, really.
Yeah.
You're marking now the 27 level, which is going to be the next stop. But really, if you look at the long-term chart, this move is way overstretched. I wouldn't really. I would be very surprised to see another 10% leg higher from here.
I kind of agree with you in the sense that it is kind of overbought or whatever. I, however, do still think the path of least resistance is to the upside for silver, because of, technically, the path of least resistance is to the upside because we haven't created a lower low. But fundamentally, the drive towards cleaner energy, and if you think about silver, how it's used in solar panels and things like that, suggests that over time demand for silver is going to rise from the renewable energy sector, and silver as a commodity is going to see increased demand for it. So I think if you look at the two metals, gold and silver, out of the two, with silver also being significantly undervalued in terms of a historical gold-silver ratio, then I think silver has the potential to go up a lot higher, I think, in my view, in the long term. But obviously, the question is, in this webinar, we are talking about short-term to kind of medium-term developments, right? So from a trading point of view, how do you get on board? And I kind of think that, with price making higher highs and higher lows, this support area right here is key. And what you want to see here is a bit of consolidation, as Victor just said, and see if price forms any bullish price action around this area. So, for example, if it does something like I don't know, let me just get this. Say it comes down, hits this level, goes back up, and then creates a higher high like that, and it starts to break out of a trend line, like, for example, around here, then that's where I would look for fresh long setups in silver, because ultimately the trend, the longer term trend, is still bullish on the daily time frame, and you want to be going with the trend rather than against it. So yes, shorting it if you're very brave in the short term might make sense, especially given the false breakout above the 30 level yesterday. However, I don't think the longer term bullish trend has changed materially yet. So for that reason, I continue to expect the dips to be supported, and I therefore would be more inclined to look for bullish than bearish setups. So that's my view, but obviously that view can change depending on how price behaves. But this is what I think might happen. So a bounce from this key support area. So gold, you're bearish on gold by the same kind of token?
Well, by the same kind of token, I feel like we might have created a very big bull trap yesterday for all those who were seeing silver go up 11 or 12% and being puzzled why gold hasn't caught up with it.
Yeah.
So they probably went long, anticipating
that breakout.
That gold is going to catch up, but it hasn't happened. We're still hovering near this 200-day moving average, quite a long time already. Unlike previous cases, if you scroll back or just zoom out of this chart, the visits to the 200-day moving average in gold have lasted on average about 3 days. We've been here for 2 weeks probably, or more, 3 weeks, I would even say. So there is another one in March. If you look at it.
Where's it going? Here?
Yeah, well, that one lasted 5 days, so sorry. And I really don't, for me, this is a worrying sign for bulls.
Because we haven't rallied away from it, Yeah,
the monthly chart continues to be very bearish for me. I re-emphasize it every time we talk about
you do,
this
so Victor is talking about these candles
asset
on the monthly time frame.
Basically we have hit 1920 1, 2, 3, 4, 5, 6 times. We haven't been able to sustain above. So for me, this is gold is up for a major correction. Couple that with some fundamentals like no more risk of coronavirus complications, which we're far from risk? There.
That's a very brave thing to say.
We're far from there, but as we know, markets are moving in anticipation of something happening.
Oh, yes.
And not on the fact of it happening. In reality, this is why we have the age-old saying, buy the rumor, sell the news.
Sell the news, yeah.
So we have there is an anticipation that the breakdown in gold started when we had the first vaccine news.
Yeah.
The rollout of the vaccines is going to be this trigger for me to push prices of gold lower and lower, because that's the least productive investment that you can make. That's not to say that you shouldn't own gold, but gold is insurance. It's not
risk.
It's not risk. Exactly.
Yeah.
So while it has been behaving as a risk asset over the past year, we should be mindful that in fact it's not. It's a safety asset. And
traditionally it's been a safe haven asset. Yeah.
And for me, this whole picture is really, the prices of gold here are really overstretched, and I expect a move towards 1750 initially, and once we take that out, probably 1600.
Oh wow, okay, so quite bearish in your forecast. So obviously price action has kind of agreed with you so far. It's every time it's kind of attempted to break out to the upside, it's gone back straight down, hasn't it? So for example, here we saw a breakout attempt, and then straight away price fell, trapping the bulls. We saw another attempt here. Yet again, that failed to materialize into anything. And maybe we have seen another one here. And so far, we haven't fallen sharply, but this could be the latest one, trapping the bulls. Let's see what happens. I don't have too strong a view on gold, to be honest. I was quite bullish on it a long time ago, and rightly so, because I thought it was undervalued. It would go to 2000. It eventually got to that level. In recent months, I have kind of maintained a bullish bias towards gold, but not as a strong bullish bias as I had previously, because price has kind of done what I expected it to do in the past. And the factors that Victor just mentioned that should play an important role, those fundamental factors when investors think of gold. And so there is less need for investors to hold gold now compared to in March, when things were looking quite bleak in terms of coronavirus and the pandemic. So for that reason, I continue to expect silver to outperform gold. Yes, it's quite sharply lower today, but longer term, I think silver is going to perform much better than gold. Which brings us to crude oil. Crude oil prices have broken out of the recent consolidation. This is the WTI contract. You know, in recent days, we had been consolidating in a very narrow range around this area. Several days of consolidation, and boom, we've broken out. So the key level of support that now needs to hold is around 53, 70-ish. The point of origin of the breakout. And if that level breaks and price goes on to take out the low that was formed prior to the latest breakout at 51.60-ish, that would be the turning point. So as we have spoken in the previous webinars, we are still technically bullish on oil because price action is bullish, but fundamentally, I certainly don't think the rally is going to last too long. I mean, it may, that the bullish characteristics may last a little bit long, a little bit longer than I had imagined, but from a purely demand and supply point of view, I can't see oil prices sustaining the rally for too long. Now, that being said, I'm not going to short it right now. I will wait for the right moment. You know, specifically in this case, if it breaks back below the recent lows. But be careful as price of oil continues to make higher highs, because I think we are getting closer to the top for crude oil. And similarly, the Brent contract bounced once again from this bullish trend line, and it's kind of heading towards the 78.6 Fibonacci retrace, which is where it previously fell from. And that level kind of comes in close to the psychologically important $60 level, where Brent crude oil may come into a bit of trouble. But the trend is bullish, so I wouldn't short it until the charts tell you it's the time to do so. So in other words, it's risk on. Gold and silver are struggling, crude oil is rallying, stock markets are bouncing back. As you can see here, the DAX is up 8.4, Euro Stoxx 50 is up 1%, the IBEX is up 1.5 today. The VIX is down, as you can see. So it's risk on today, and that kind of begs the question: what the hell is the dollar doing, being up?
Yeah. That's the thing that really makes a difference this time around.
Yeah. So on that bombshell, we're going to end the webinar. Thank you so much, guys, for joining us. Please join us again at the same time, 11:30 GMT on Tuesday. But by the way, we have a Nfp Preview Webinar this week. So for those of you who want to join us, I'm just going to show you where to go. So if you go to our website, Think Markets, go to Market Analysis, Live Webinars. These are all our upcoming webinars, and you can see that ahead of Tuesday's next live market analysis, we have the non-farm payrolls webinar, which is happening at 11:30 London time on Friday. So a couple of hours before the jobs report is out. So please join us for that webinar, and I will look forward to speaking to you then. Have a lovely weekend. Have a lovely week, rather. And it feels like a weekend, doesn't it, for some reason? At least for me, it does. But yeah,
you guys are in London are in lockdown, so that might have an effect.
It's weekend every day. Yeah, we're at home doing nothing. Yeah. So yeah, join us then, and hopefully I will see you there. Take care. Bye bye.
Take care. Bye bye.